Welcome to the deep dive. We are so incredibly glad you're here with us today.
We really are.
And if you are listening to this right now, you're probably the kind of person who really loves to learn.
Someone who wants those actual aha moments.
Exactly.
Yeah.
You want to understand the structural realities beneath the surface of the daily news cycle. You aren't looking for just a basic summary.
Right, you want the deep knowledge.
You appreciate it when dense, heavily technical frameworks are decoded and made directly relevant to the real-world mechanics of global markets. And that is exactly what we're here to do for you today.
It's going to be a fun one.
Okay, let's unpack this. Today's mission is to decode the hidden, incredibly high-stakes world of corporate group audits and consolidated financial statements.
Which sounds dry, but I promise it is not.
I know what you might be thinking. Consolidated financial statements, statutory audits. Are we really doing this?
We are definitely doing this.
Yes, we are. And I promise you, the reality of this subject is far more fascinating and, frankly, far more cutthroat than it sounds on paper.
Oh, absolutely.
Our source material today is a dense, highly technical stack of real-world scenarios, case studies, and regulatory frameworks. They are pulled directly from the trenches of statutory auditing.
Real frontline stuff.
Yeah. We are looking at the strict rules of IND AS 110. We are looking at the complex web of standards on auditing, like SA 600, SA 706, and SA 550.
And the heavy legal architecture of the Companies Act.
Right. On the surface, it reads like a dry regulatory manual. But when you look closer, these texts are actually a collection of intense corporate mystery.
And legal loopholes.
Exactly. It is this ongoing, highly sophisticated cat-and-mouse game between massive multinational corporations and the statutory auditors, whose literal job it is to enforce reality.
It really is a fascinating dynamic. And to understand why this matters so deeply to you, the listener, you have to think about the fundamental concept of market trust.
Market trust, yeah.
Right, because whenever you see a news alert about a massive global corporation announcing record-breaking quarterly profits.
Or a shocking downgrade in their earnings forecast.
Yeah, exactly. Whenever you see those headlines, you are relying entirely on the invisible architecture of financial consolidation. You're relying on the rigorous, often really combative detective work of statutory auditors.
Because these massive companies are never just one simple business anymore.
No, never. Modern conglomerates are rarely just one single, unified operating company. They are these vast, sprawling, and sometimes intentionally opaque webs.
Webs of parent companies, operational subsidiaries, strategic joint ventures.
And offshore special-purpose vehicles. So to figure out if the overall corporate empire is actually generating value, or if it is just shuffling debt around to look profitable, you have to smash all those individual financial statements together into one single coherent document.
And that document is the consolidated financial statement.
That's the one. And if the rules governing how that document is put together are loose, or if a parent company can surgically hide a failing, highly leveraged subsidiary off their main books through some kind of technicality,
The whole thing falls apart.
the entire global financial system becomes a house of cards. What we are doing in this deep dive is revealing exactly how that consolidation process works, how the regulatory standards actively prevent deception.
And how auditors are legally mandated to act as the ultimate line of defense for institutional investors, retail shareholders, and the public at large. That concept of market trust is so crucial, because without a unified set of rules, corporate management would have an infinite number of ways to present their own reality.
They would just tell whatever story made them look best.
Exactly. So let's dive right into one of the most common battlegrounds between management and auditors. This centers around what we can call the illusion of temporary control.
This is a classic one.
It really is. It is a recurring scenario that pops up repeatedly in the case studies we reviewed. Here is the basic real-world setup. Imagine a large publicly traded parent company. Let's call them Parent Ltd.
Okay, Parent Ltd.
During the financial year, they execute a leveraged buyout or a strategic acquisition, taking a majority stake, say 51% of the equity shares in another operating company. We will call that one Child Ltd.
So they have the majority.
Right. By all standard mathematical logic, Parent Ltd. now controls Child Ltd. They have the majority voting rights.
Simple math.
But here's the twist that management tries to play. Fast forward a year, or perhaps even just a few months later in the very same financial year, and Parent Ltd. turns around and sells a portion of those shares.
Yeah.
Maybe they sell off 20%, dropping their ownership down to 31%.
Which is well below that crucial 50% majority line.
Exactly. Now, when the end of the fiscal year approaches and it comes time to prepare their big consolidated financial statements, parent LTD's management presents a very convenient, highly polished argument to their statutory auditor.
I can hear the pitch already.
Right. They say, listen, we shouldn't have to include child LTD in our consolidated group financials at all.
Yeah.
Yes, we crossed the 50% threshold, but our control over them was just temporary.
Just a phase.
Just a phase. They say, in fact, we only ever held those shares as quote-unquote stock in trade, exclusively with a view to dispose of them in the near future. It was just a short-term strategic flip.
Right.
Therefore, to provide a more accurate picture of our long-term holdings, we are excluding them from our consolidated statements.
It sounds so reasonable when they say it like that.
It does. On the surface, if you don't know the regulations, that might sound like a somewhat plausible business argument. But how does the regulatory framework actually handle this kind of maneuvering?
The regulatory framework brings down the hammer with absolute precision.
The hammer comes down.
Hard. Specifically, we have to look at the Indian Accounting Standard 110, or IND AS 110. This is the standard that governs consolidated financial statements.
Okay.
As an auditor, when a CFO or a corporate management team presents this temporary control argument, you have to point directly to the text of IND AS 110 and deliver the reality check.
Which is?
There's absolutely no exemption for temporary control. None. The standard is intentionally rigid.
So they just shut it down entirely.
Completely. It also explicitly states there is no exemption for operations under what they call severe long-term funds transfer restrictions.
What does that mean in plain English?
It is another excuse companies use when they acquire a subsidiary in a foreign country, a country with strict capital controls. The parent company claims they can't consolidate because they can't freely move the cash out of the country.
Oh, I see. Like, we own it, but we can't touch the money, so don't make us consolidate it.
Exactly. And NDS 110 says, no, nice try. Under NDS 110, if you are preparing compliant financial statements, consolidation is absolutely mandatory regardless of your future intent or cash flow restrictions.
Wow.
What's fascinating here is the absolute surgical precision of the timeline the standard enforces.
How specific are we talking?
The accounting standard specifically dictates that the consolidation of an investee's financials shall begin from the exact date the investor obtains control, and it shall cease the exact date the investor loses control.
So it is a daily tracking system, essentially.
It is a binary day-to-day state. You either have control or you do not.
Cool.
The duration of your intention to hold that control or the strategic classification of those shares as stock in trade is entirely irrelevant to the accounting standard.
So if parent LTD held 51% of child LTD for exactly 6 months and 4 days,
Then for those specific 6 months and 4 days, child LTD's assets, liabilities, income, and expenses must be consolidated line by line into parent LTD's financial statements.
wow.
There is no prorating the truth based on corporate strategy.
That level of rigidity is fascinating because it completely removes the subjective element from the equation. It stops management from retroactively rewriting the narrative of their fiscal year.
Exactly. It forces them to live in reality.
To put this in a more structural business context, think about the mechanics of something like flipping a house.
Okay, I like this.
Imagine you buy a house with the explicit intention to flip it in a few months. You know you aren't going to live there forever. Your entire business model is to hold it for maybe 8 months, put on a new roof, and spin it back out to the market.
Right, it's just inventory to you.
Exactly. You might view that asset as purely transactional, just inventory passing through your hands. But when the local government looks at it, they don't care about your internal investment thesis.
They really don't.
They just look at the legal ownership. Even if your ownership is temporary, you can't just pretend you don't own it. You still have to pay the property taxes. You still have to maintain it. You still have to declare it on your personal taxes.
You own the liability.
Exactly. While you hold the deed, you own the consequences of that property. And it is the exact same with corporate control. You own their debt on your balance sheet, you own their operational liabilities, and you must report their revenues and expenses alongside your own.
You cannot shield your primary investors from the reality of the risks you took on.
Even if those risks were designed to be short-lived.
That captures the essence of the rule perfectly. And if we look deeper at the underlying motivations, the actual why behind a company going through the immense effort of arguing with their auditor to utilize this temporary control loophole.
Because there's a lot of effort.
It is a massive fight, but the financial stakes make it incredibly clear. Why hire expensive accounting firms to try and justify keeping an asset off the books?
To hide something ugly.
Almost universally, yes. It is because the subsidiary in question is a toxic asset, or at the very least, it negatively impacts the parent company's key performance indicators.
Give me a scenario.
Imagine Parent Ltd. Acquires a company that, upon closer post-merger integration, turns out to be bleeding cash.
Just hemorrhaging money.
Right. Drowning in high-interest debt, or maybe facing massive, unquantified legal liabilities.
A total nightmare acquisition.
If Parent Ltd. is forced to consolidate that subsidiary, all that debt and all those operational losses are suddenly and violently visible on Parent Ltd.'s main consolidated balance sheet.
Which ruins the parent's numbers.
It would instantly crush their consolidated profit margins, it would severely negatively impact their return on assets, and potentially trigger breaches in their own debt covenants with major banks.
Oh man, triggering debt covenants is a disaster.
It would terrify their institutional shareholders and cause a massive sell-off. So the parent company's management team tries to quarantine the toxic subsidiary.
They try to fence it off.
They attempt to use the stock and trade argument to say, listen, we are getting rid of this soon, so let's just keep it off the consolidated books entirely so we don't spook the market.
But in AS 110 forces the economic reality into the light.
It forces companies to publicly own their capital allocation decisions, even the bad short-term ones.
That makes a lot of sense.
Now, the regulatory materials do mention a slight, highly specific nuance regarding the broader legal framework of the Companies Act, 2013.
Okay, what is the nuance?
Specifically, there's an intersection between Section 129, subsection 3 of the Act and Rule 6 of the Companies Accounts Rules, 2014.
Getting into the legal weeds?
A bit, yeah. The legal text basically states that if a company is not required to prepare consolidated financial statements under the applicable accounting standards, it is sufficient if they comply with the disclosure provisions in Schedule 3 of the Act.
So wait, does that give them a loophole?
No, that is the brilliant part. In all the practical case scenarios we analyzed, the conclusion remains identical. A company might aggressively argue that their intention to dispose of the shares makes their control temporary. But because the ultimate authority in AS 110 explicitly offers no temporary exemption, they are still legally required to prepare full consolidated financial statements.
So they are trapped by the accounting standard anyway.
Exactly. For the exact literal duration they held control. The accounting standard closes the door that the corporate lawyers try to open.
It is a phenomenal systemic safeguard. When you think about it from the perspective of an institutional investor, or even just a retail trader trying to evaluate a company's long-term health, this strictness is the only thing keeping the markets functional.
It is the bedrock of transparency.
If a publicly traded corporation had the unilateral power to selectively hide all of their disastrous short-term acquisitions by simply labeling them temporary strategic investments,
It would be chaos.
the financial statements you rely on would be fundamentally structurally misleading. You would only ever see the successes, the profitable core business, while the massive capital-destroying failures were quietly swept under the rug of stock and trade.
You'd never see the full picture.
The uncompromising nature of NDAS 110 is literally the mechanism that allows capital markets to price risk accurately. So that establishes the baseline. If you cross the 50% line, you consolidate. Full stop.
Full stop.
But let's pivot to something that completely upends our traditional mathematical understanding of corporate control.
This is where things get really interesting.
It really does. This brings us to a concept we can call power without majority. We just spent a lot of time establishing how a 51% ownership stake triggers mandatory consolidation. But the research materials present a scenario that is completely counterintuitive to anyone who learned basic business math.
Let's hear it.
We have a scenario involving a company, let's call them ALTB, which holds a mere 10% of the voting power in another company, BLTD. 10%. Mathematically, a 10% stake is essentially a rounding error in the context of corporate control. It's a minor minority stake. You would naturally assume ALTD is just a passive investor, maybe holding a board observer seat at best.
Just along for the ride.
Right. But the case study reveals a crucial hidden detail. ALTD, despite only having that tiny 10% slice of the voting power, legally holds the absolute right to control the composition of the board of directors of BLTD.
And that changes everything.
Because of this specific contractual right, the auditing standards dictate that ALTD is legally considered the parent of BLTD. And ALTD must consolidate 100% of BLTD's financials into its own statements as a full subsidiary.
It is a massive shift in perspective.
How does a framework as rigorous as accounting reconcile the fact that 10% equals 100% control?
This specific scenario highlights where modern accounting frameworks have truly evolved to reflect the complexities of advanced corporate structuring. And AS 110 represents a massive, paradigm-shifting evolutionary leap from older, legacy accounting standards.
How did it work in the old days?
Historically, going back a few decades, corporate control was defined almost entirely by simple quantitative math. If you owned more than 50% of the voting shares, you had control.
Clean and simple.
It was incredibly easy to calculate. It made the auditor's job simple. But it was also incredibly easy for sophisticated financial engineers to manipulate.
Oh, of course.
Companies, particularly in the lead-up to major financial crises like Enron, realized they could easily control the risks and rewards of another entity without actually owning the majority of the equity shares.
So they would game the system.
Exactly. They would set up complex special-purpose entities,
Yeah.
keep their equity stake at 3% or 10%,
Yeah.
but design the contracts so they dictated every single move the entity made.
And under the old rules.
Under the old rules, because they didn't hit 51%, they kept massive amounts of leverage and risk entirely off their balance sheets.
Which is terrifying.
It was. So in AS 110 changed the game by redefining the very concept of control to mean actual operational de facto power over the investee's relevant activities.
So it looks past the math.
It trains auditors to look past the superficial legal ownership percentages to see who is actually pulling the strings and absorbing the variable returns.
So in this 10% scenario, the logic holds up.
The logic is perfectly sound. The board of directors is the ultimate governing body of a corporation. If ALTD has the unilateral contractual right to appoint, remove, or dictate the actions of the majority of the individuals who sit on the board of directors of BLTD,
Then ALTD effectively controls the entire strategic direction.
they control the hiring and firing of executive management, the capital expenditure budgets, the dividend policies, everything. Therefore, they are the true parent company, and the 10% shareholding is just a structural technicality.
But while this makes economic sense, it creates a massive, incredibly complex challenge for the statutory auditor, right?
Oh, an absolute nightmare. When control was based on a simple 51% ownership metric, the auditor just had to request the cap table or the share registry. Simple math, easily verified.
You just count the shares.
Right. But how do you systematically audit invisible operational control? How do you prove who holds the real power?
It sounds like detective work.
The regulatory frameworks provide the auditor with a very specific, intensive roadmap for this kind of detective work. The auditor must verify the precise mechanism of how ALTD exercises this control.
So they have to look outside the ledgers.
They have to step entirely outside the basic financial ledgers. They must scrutinize the minutes of every board meeting to see who is really driving the strategic decisions, looking for patterns of dominance.
Reading the fine print.
Exactly.
Yeah.
They must deploy corporate lawyers to read through dense, complex shareholder agreements entered into by the parent to identify hidden veto rights or golden shares.
Here's where it gets really interesting. The source material explicitly mentions that auditors are required to look at agreements to which the parent might have provided any technology or know-how.
Yes, the technology agreement.
Let's really unpack the implications of that in the modern, hyper-specialized global business environment. Let's move away from traditional manufacturing for a second.
Okay, where are we going?
Imagine ALTD is a massive, dominant tech conglomerate. They have developed a highly specialized proprietary artificial intelligence algorithm, or perhaps an essential patented semiconductor architecture.
Something totally essential.
Exactly.
Yeah.
BLTD is a smaller downstream company. Their entire business model, their entire supply chain relies absolutely on accessing ALTD's intellectual property.
They cannot survive without it.
Right. So ALTD might approach BLTD and say, listen, we aren't going to buy you out. We will only take a 10% equity stake in your company just to align our interests.
Sounds friendly enough.
But then they drop the hammer. They say, however, as a strict, non-negotiable condition of licensing our core technology to you, a license without which your company would cease to exist tomorrow, we require an ironclad agreement that gives us the right to appoint the CEO and the majority of your board of directors.
Wow. And BLTD has to say yes.
BLTD, having no leverage, has absolutely no choice but to agree. In this scenario, A Ltd. holds B Ltd. completely hostage through technological dependency and supply chain dominance.
That is a brilliant illustration.
They don't need to deploy the capital to buy 51% of the shares. Their technology license is the ultimate weapon of corporate control. When the statutory auditor comes in and uncovers this specific technology agreement, they have to recognize the underlying economic reality of the situation.
Which is that ALTD is the undisputed master of BLTD.
The operational risks and rewards flow back to ALTD. Therefore, full line-by-line consolidation is required to reflect the true, unvarnished economic reality of ALTD's corporate empire.
Exactly. That is a brilliant illustration of de facto control. Or, as the regulatory text also notes, control can be established through the enforcement of a statute.
Meaning the government steps in.
Right, where government regulations might grant a minority shareholder outsized administrative control over an entity in a regulated sector, like telecom or energy. There are myriad ways absolute power can be wielded without a majority shareholding, and the modern auditor is expected to uncover all of them.
That is a lot of responsibility.
And crucially, once the auditor confirms this operational control exists, their job isn't over. It's really just beginning. They must then ensure that all the highly complex accounting adjustments warranted by IND AS 110 are mechanically made.
And authorized by management.
Properly authorized by the parent's management. This includes planning a comprehensive group audit, deeply understanding the often disparate accounting policies of both the 10% owner and the controlled entity.
And programming the audit procedures.
Programming the exact nature, timing, and extent of the audit procedures required to merge those financials. Furthermore, the source material explicitly brings another critical standard into the discussion here.
Which one?
Standard on Auditing 550 or SA 550.
What does SA 550 cover?
SA 550 deals entirely with the concept of related parties. The core principle underlying SA 550 is that an entity that has control, or even just what the standards call significant influence, which is usually presumed at a 20% voting stake, either directly or indirectly through a chain of intermediaries over the reporting entity, is legally considered a related party.
So they get flagged.
The auditor's statutory duty is to meticulously review all information and documentation provided by management identifying these related parties.
Why is this related party designation so heavily regulated?
Because transactions between related parties are inherently not conducted at arm's length.
They aren't normal market transactions.
Exactly. They are not subject to the normal friction-heavy forces of a free market. If ALTD controls BLTD through that technology agreement, ALTD could theoretically force BLTD to sell them finished goods at a massive artificial discount.
Just extracting value.
Or force BLTD to take on a loan at an exorbitant interest rate. These kinds of transfer pricing manipulations distort the financial reality of both companies, shifting profits to low-tax jurisdictions or hiding losses in unlisted entities.
So the auditor has to catch that.
The auditor must rigorously evaluate whether these complex relationships and the resulting transactions have been properly accounted for, valued at fair market equivalence where required, and transparently disclosed in the notes.
That is a massive undertaking.
Ultimately, the auditor must make a professional judgment on whether the aggregate effects of these related party relationships prevent the financial statements from achieving a true and fair presentation. Or worse, if they're designed to be downright misleading to the public markets.
All aimed at stopping corporate engineers from using shadow entities and legal technicalities to manipulate their bottom line.
Exactly.
So if we have firmly established the baseline that control, whether it's achieved through a blunt 51% equity shareholding or through sophisticated operational dominance like board control or tech agreements, absolutely mandates consolidation under the strict rules of IND AS 110.
We have established that.
We have to ask the logical next question. Are there any exceptions to this rule at all?
A valid question.
Is there ever a scenario where a company owns a massive, undeniable controlling stake in another business, holds all the power, but is legally allowed by the accounting standards to not consolidate them?
It turns out there's one major exception.
But it requires the parent company to operate under a fundamentally different type of business model than a traditional conglomerate.
Right.
This brings us to what we can call the investment entity exception. Our research introduces a scenario featuring a company named H Limited.
Let's talk about H Limited.
H Limited operates strictly as an investment company. During the financial year under audit, H Limited aggressively deployed capital and acquired massive, undeniable controlling stakes in 3 different operating companies.
Real major stakes.
They took 25% in S1 Ltd., a clean 50% in S2 Ltd., and a whopping undisputed 60% majority stake in S3 Ltd.
So they hit the mathematical thresholds.
Based on everything we just discussed regarding S3s and 110, your immediate instinctual reaction as an auditor or an investor should be to shout, consolidate.
Consolidate right now.
Exactly. They own 50% and 60%. They have absolute control. They must immediately consolidate the financials of S2 and S3 line by line. But in this highly specific scenario, NDAS 110 grants a rare, complete, and total exemption.
The total pass.
H Limited does not have to consolidate these subsidiaries. Instead of merging the balance sheets, they are permitted to simply measure all of these subsidiaries at fair value through profit or loss.
Which is completely different.
Why does this specific type of company get a regulatory-free pass when every other industrial conglomerate is held to such incredibly strict consolidation standards?
They get a pass because the standard setters realized that forcing them to consolidate would actually destroy the utility of their financial statements.
It would make them worse.
It would make the data less useful to an investor trying to understand the business. The exception relies on H Limited proving, beyond a shadow of a doubt to their auditor, that they meet the incredibly specific multi-pronged definition of an investment entity under IND AS 110.
Okay, what are the prongs?
The standard outlines 3 rigid, non-negotiable criteria that an entity must meet to claim this elite status. First, the entity must obtain funds from one or more external investors for the express, singular purpose of providing those investors with professional investment management services.
So they are managing other people's money.
Right. Second, the entity must formally commit to its investors, usually in its prospectus or founding charter, that its sole overarching business purpose is to invest funds solely for returns from capital appreciation, investment income, or a combination of both.
They just want a return on investment.
Exactly. They are not there to run the day-to-day operations of the businesses they buy. Third, and most importantly from an accounting perspective, the entity must measure and evaluate the financial performance of substantially all of its investments on a fair value basis.
If we connect this to the bigger picture of the global financial ecosystem, it makes perfect logical sense.
It really does.
Think about the operational realities of a massive global mutual fund, or a top-tier venture capital firm,
Better.
or a sovereign wealth fund.
Let's use the VC firm as an example.
Let's say a major venture capital firm deploys its latest fund and buys a 60% controlling stake in a brand new, pre-revenue SaaS software startup. Then a 55% controlling stake in a highly capitalized biomedical research lab that is years away from FDA approval, and a 60% stake in a mature company that manufactures specialized deep-sea mining equipment.
3 totally unrelated businesses.
If the rigid accounting rules forced that venture capital firm to act like a traditional corporate parent and mathematically consolidate those entities, they would have to merge the recurring revenue from software subscriptions, the massive R&D burn rate from the medical trials, and the heavy machinery inventory of the mining company into one single unified financial statement.
That resulting document would be absolute unmitigated chaos.
It would be a completely meaningless statistical soup.
Totally unreadable.
If I am an institutional investor, say, a pension fund, who allocated capital to that venture capital firm, I do not care about the day-to-day combined operational revenue of 50 wildly different, disconnected startups spread across a dozen industries.
It doesn't tell you anything you need to know.
I am not investing in that VC firm because I want them to build a unified, synergistic corporate conglomerate like General Electric or build a massive supply chain.
No, you want a return.
I am investing purely in the fund manager's ability to identify underpriced assets, pick winners, and exit at a multiple. I only care about one single metric: the current mark-to-market value of the portfolio.
Exactly.
Has the intrinsic value of those startup shares gone up since we bought them, or have they gone down? That is why evaluating performance on a fair value basis is so conceptually crucial to this exemption.
That is the crux of it.
By measuring the subsidiaries at fair value through profit or loss, the investment entity essentially treats its 60% controlling stake the same way you or I would treat a few shares of Apple stock in our personal brokerage account.
It's just a line item.
They simply report the current estimated market value of that equity stake as a single line item asset on their balance sheet, and any change in that value flows directly through the income statement, rather than absorbing all the underlying messy operational clutter of payroll, inventory, and individual debt covenants.
It provides a much cleaner, truer, and far more relevant picture of an investment fund's actual financial health and
It
performance.
really does.
Precisely. The goal of accounting is to provide useful information, and consolidation in that context creates noise, not signal.
But there is a catch, right?
However, the regulatory framework includes a very important, highly technical caveat in this scenario that prevents this from becoming a black hole of information.
Okay, what's the caveat?
While the core accounting standard, IND AS 110, gives age-limited a pass on the actual mechanical line-by-line consolidation, they are still subject to the broader, overarching laws of the jurisdiction.
Which in this case is the Companies Act, 2013.
Correct. The legal text points out that Section 129, subsection 3 of the Act, establishes a general, foundational requirement that any company with subsidiaries must prepare consolidated financial statements.
So the law says do it, but the standard says you don't have to.
But the legal framework is smart enough to defer to the accounting experts. The company's accounts rules, 2014, state that this consolidation should be done strictly in accordance with the applicable accounting standards.
Ah, so it loops back around.
Since IND AS 110 is the legally applicable standard for this class of company, and it specifically provides an exemption for investment entities, H Limited follows the exemption.
So they are legally clear.
The ultimate legal conclusion drawn in the regulatory guidance is that the final authority on the manner of consolidation is the accounting standard, or IND AS, as prescribed by law. If this sanctioned accounting law gives a structural exemption, it is legally sound to follow it.
But they still have to tell the market what they own, surely.
This is a critical point for market transparency. If massive, heavily capitalized subsidiaries are excluded from consolidation due to this investment entity exemption, the parent company cannot just pretend they don't exist in the public record.
They can't just hide them.
The investment entity must explicitly, meticulously disclose the full list of these non-consolidated subsidiaries in the detailed notes to the accounts.
What goes in those notes?
They must detail their ownership percentages, the jurisdictions they operate in, and crucially, provide the specific regulatory justification for why they meet the criteria for exclusion.
So you get to skip the messy, misleading math of operational consolidation.
But you still have to fully declare the architecture of your holdings to the world.
I love the elegance of that built-in safety net. You are permitted to use the structural exception because it makes economic sense, but you have to show your work and justify your logic in the margins of the financial statements.
It's a very elegant solution.
Yeah.
Now, we have spent a lot of time analyzing the theoretical rules of consolidation, the specific triggers for when to do it, and the very narrow exceptions for when not to do it. But let's shift our perspective away from the rule book. Let's step directly into the shoes of the person who actually has to enforce all of this on the ground.
Let's talk about the auditor.
Let's look at the statutory auditor. We've established the baseline rule. If a parent company controls a subsidiary, either through equity or operational dominance, it must be consolidated.
Right.
But when you are sitting in an audit room dealing with a massive global holding company that might have hundreds of components, shell companies and joint ventures scattered across 50 different legal jurisdictions, how does the auditor actually know they're looking at the whole picture?
That is the million-dollar question.
How do they ensure that a highly incentivized management team hasn't conveniently forgotten to include a poorly performing, highly leveraged component in the consolidated statements?
Just, oops, we forgot that entire company.
Exactly. The regulatory guidance details the rigorous procedures expected of auditors tasked with auditing the consolidated financial statements of parent companies.
It's a massive process.
Imagine the kickoff meeting for the audit. The corporate management team hands the auditor a pristine spreadsheet, a list of components, and they say, here you go. Here is our entire corporate structure. This is everything.
And the auditor says, thank you, I don't believe you.
Exactly. The auditor's first professional obligation is to basically say, I hear you, but my mandate requires me to assume this is incomplete until I can independently verify every single node of this structure.
The regulatory standards provide a rigorous, incredibly detailed, multi-layered checklist of investigative procedures the auditor must perform to verify the completeness of this corporate map.
This section of the standards reveals the fundamental underlying psychology of the auditing profession, doesn't it?
It really does. It is an incredibly intricate, often tense balance of trust and relentless verification. You cannot approach a client's management team with outright hostility or accusations of fraud.
Right, because you need them to work with you.
Exactly. That breaks down the communication necessary to complete the audit. But you must operate at all times with what the standards define as professional skepticism.
Trust, but verify.
You are professionally required to assume the list they gave you is potentially incomplete or biased until you can gather sufficient appropriate audit evidence to prove otherwise.
So how does an auditor actually go about finding the missing pieces in a global corporate labyrinth?
The auditing standards outline a comprehensive, multi-pronged investigative attack. First, the audit team looks backward.
Looking at history.
They meticulously review their own firm's working papers from prior years for known components. If a subsidiary in the Cayman Islands was on the organizational chart last year, and it is mysteriously missing from the list this year,
Management better have a good explanation.
they better have a very good explanation, alongside the legally binding sale agreements and bank transfer records to prove it was legitimately disposed of.
What's a second prong?
Second, the auditor evaluates the parent company's internal controls. They review the parent's established systemic procedures for identifying and recording various components.
Like checking their systems.
If the parent company's internal corporate governance and tracking systems are sloppy or highly manual, the auditor's formal assessment of the risk of material misstatement skyrockets,
Which means they have to dig deeper.
meaning they have to do far more manual digging. Third, they conduct direct, formal inquiries of management and those charged with governance to explicitly ask about the creation of any new components or the dissolution of old ones.
Getting them on the record.
Fourth, they deploy a forensic approach to the balance sheet. They scour the investments ledger of the parent company, as well as the investments ledgers of all the known components themselves, to determine if there's any hidden capital flowing into other, undisclosed entities.
Hunting for nested Russian dolls.
Precisely. Subsidiaries of subsidiaries that the parent might claim they forgot to roll up to the top level. Fifth, they rigorously review all joint ventures and joint arrangements, because these are classic vehicles for hiding off balance sheet debt.
And the final piece.
Sixth, they look for other arrangements entered into by the parent that haven't been formally classified as investments. This is exactly where they might find those sneaky, indirect technological control agreements or restrictive supply chain contracts we discussed earlier, which grant de facto control without equity ownership.
And then, after all that internal review, we get to the really heavy regulatory weaponry.
The statutory records.
The statutory records. The standards explicitly mandate that auditors must rigorously review the statutory registers legally maintained by the parent company under the Companies Act 2013, specifically pointing to Section 186 and Section 190.
These are crucial documents.
Now, for the listener who might not spend their weekends reading corporate law, let's break down what those specific registers actually represent in the real world.
Let's do it.
Section 186 deals with a strict registry of a company's loans, guarantees, and investments. If a parent company's management is secretly funneling millions of dollars of capital into an unlisted, off-the-books shell company to keep it afloat,
The actual financial transaction has to be there.
the movement of cash legally has to be recorded in this specific register. Section 190 deals with a registry of contracts or arrangements in which the company's directors are legally interested.
Which is prime territory.
It is absolute prime territory for an auditor hunting for undisclosed related parties. To put this in a relatable modern business context, imagine trying to map out the entire financial exposure of a highly complex, decentralized global supply chain.
Okay, map it out.
Management gives you a flowchart showing their primary suppliers. But you know that in modern logistics, there are dozens of intermediary holding companies, freight forwarders, and custom brokers. To verify the true flow of capital and risk, you can't just look at the high-level flowchart they printed out for you.
It's not enough detail.
You have to demand access to the underlying granular data, the raw customs declarations, the bills of lading, the interbank wire transfer logs. You have to comb through the raw, unfiltered data to find the hidden nodes of exposure.
Right.
In the corporate auditing world, those statutory registers under Section 186 and 190 are the raw data. They hold the undeniable, legally mandated paper trail of where the capital is actually flowing, regardless of what the polished organizational chart claims.
That is a highly accurate comparison. You are bypassing the narrative and going straight to the data. But the auditor's toolkit doesn't stop at just searching through historical records and ledgers.
There's more.
There is a powerful psychological and ultimately legal tool they deploy at the very end of the process to enforce ultimate accountability. This brings us to the concept of written representations.
Which sounds very formal.
It is. It is formally governed by Standard on Auditing 580 and is a critical step before any audit opinion is finalized. After the audit team has spent thousands of hours doing all their hunting, checking the statutory registers, reviewing the complex investments, and arguing over consolidation exemptions,
They are exhausted, but nearing the end.
they are nearing the completion of the audit engagement. But before the lead audit partner physically signs their name to the independent auditor's report, which legally validates the consolidated financial statements to the global markets, they require the parent company's executive management, usually the CEO and CFO, to formally, legally commit to the claims they have made throughout the year.
They make them sign on the dotted line.
The auditor literally makes them put their assertions in writing. The auditor obtains a formal letter of representation from the management covering all matters material to the consolidated financial statements.
What goes into that letter?
The regulatory standards dictate highly specific elements that must be included. Management must declare, in writing, under threat of legal penalty for perjury or fraud. First, the absolute completeness of the components included in the consolidated financial statements.
They are legally stating on the record that they didn't hide any subsidiaries or shell companies.
Exactly. Second, the accurate identification of all reportable segments for segment reporting, ensuring they aren't hiding a failing product line inside a profitable one.
Smart.
Third, the exhaustive identification of all related parties and related party transactions. And fourth, the appropriateness and completeness of all permanent and current period consolidation adjustments, specifically including the elimination of intragroup transactions.
Let's pause and really drill down on that last point.
The intragroup transactions.
Yes, the elimination of intergroup transactions. Because understanding that mechanic is absolutely critical to understanding how the math of consolidation actually works in practice. Let's use a tangible example.
Tangible examples are always good.
Imagine a parent company that owns a massive mining operation. Let's call it Subsidiary A, and a separate manufacturing plant, Subsidiary B.
A and B.
Got it. Subsidiary A mines $10 million worth of raw lithium and sells it directly to Subsidiary B, who uses it to make batteries. On their individual, standalone financial statements, Subsidiary A records $10 million in massive new sales revenue. And Subsidiary B records $10 million in raw material expenses.
They both look like they are doing huge volumes of business.
Exactly. But from the overarching perspective of the parent company looking at the entire economic group as a single entity, absolutely no new money has entered the corporate empire from the outside world.
It's an internal transfer.
They haven't sold anything to a real customer yet. They've simply moved $10 million of value from their left pocket to their right pocket. If the auditor doesn't strictly ensure that those specific intergroup transactions are entirely eliminated, wiped out during the consolidation process,
The parent company's total reported top-line revenue would be artificially massively inflated by $10 million.
it is classic double counting.
Classic.
Furthermore, if Subsidiary A sold that lithium at a profit markup, the auditor has to eliminate that unrealized profit sitting in Subsidiary B's inventory, because the group cannot legally make a profit by selling to itself.
Right. You can't just generate profit internally like that.
By forcing the CEO and CFO to state in a legally binding written document that all these complex eliminations have been properly and thoroughly executed, the auditor is locking management into a definitive narrative.
It's an insurance policy.
If it turns out 3 years later, during a regulatory investigation, that management intentionally lied and double-counted revenues to hit their bonus targets, that written representation letter is the ultimate smoking gun.
It absolutely is.
It shields the auditor from liability by proving they were actively deceived, and it provides the regulatory bodies with the explicit proof needed to prosecute for corporate fraud.
It is a critical layer of defense.
Okay, so we have deeply covered the rules of control, the strategic exceptions, and the aggressive toolkit the auditor uses to find the truth.
We've covered a lot of ground.
So what does this all mean when we scale these concepts up to the absolute maximum level of global complexity? This brings us to our final and perhaps most intricate structural topic:
The principal auditor.
the principal auditor and the staggering web of global reliance.
This is exactly where the sheer unyielding scale of modern global capitalism violently collides with the rigid, localized structure of accounting standards.
Collides is the right word for it.
In almost all massive multinational corporate groups, think of a global tech giant or an international automotive manufacturer, it is practically impossible for a single audit firm to deploy their own personnel to audit every single component, factory, and subsidiary of the business across 50 different countries.
They just don't have the manpower.
Nobody does. Let's look at a realistic scenario governed by these standards. Imagine a parent company. Let's call them Venus Ltd., a massive industrial manufacturer.
Okay, Venus Ltd.
They operate through 5 major business units and 35 sprawling factories and branches across an entire continent. A major auditing firm, let's say Manglam and Associates, is appointed by the shareholders as the principal auditor for the group.
So Manglam is the lead.
But before Manglam and Associates can even legally accept this monumental high-risk task, they have to undergo a rigorous self-evaluation to determine if they are actually qualified, under the standards, to act as the principal auditor.
They have to qualify themselves.
Yes. The regulatory framework outlines highly specific points of consideration. They must mathematically consider the materiality, the financial significance of the specific portion of the financial information they will personally audit with their own team.
So they have to audit enough of it.
Right. If Manglam and Associates is only physically auditing the corporate headquarters, which represents a mere 5% of the total assets and 2% of the total revenue, while dozens of other smaller, unaffiliated local auditing firms are auditing the factories that represent 95% of the actual economic engine.
They can't be the principal auditor.
Manglam and Associates cannot legally claim to be the principal auditor. They don't have enough direct exposure to the underlying reality of the business.
That makes perfect sense.
The standards also require them to assess their degree of knowledge regarding the overarching business of all the components, the inherent risk of material misstatements in the financial information audited by those other firms, and their operational ability to perform additional direct audit procedures on those remote components if necessary.
So they have to ensure their direct slice of the pie is substantial enough.
And their oversight robust enough to legally and ethically justify taking the lead on signing that final high-stakes consolidated report.
And this structural reality leads us directly into the incredibly complex scenario of relying on the work of others.
It's a huge web of reliance.
Let's imagine the principal auditor, let's call him CAM, is tasked with signing off on the consolidated financial statements of a massive parent company, D&D Limited. D&D Limited has 8 massive, highly profitable subsidiaries, but CAM and his team did not audit a single one of those 8 subsidiaries.
Not a single one.
Dozens of other local auditing firms did the actual groundwork. The corporate management of D&D Limited simply hands CAM the finalized financial statements and the signed audit reports from those other independent firms, essentially saying, here is the math, add it up.
Just compile it for us.
The regulatory scenarios provide some hard, massive numbers to illustrate the scale of this reliance. Let's say those 8 subsidiaries account for TASE. Total assets of 1,500 crore rupees, total revenues of 1,000 crore rupees, and net cash outflows of 10 crore rupees.
That is a massive chunk of the corporate empire.
A huge chunk. Furthermore, to make it even more complicated, 2 of these massive subsidiaries are located outside of the parent's home country.
Oh, foreign subsidiaries. That complicates everything.
Exactly. This means they were audited under completely different foreign accounting principles, using different depreciation schedules, different revenue recognition rules, and completely different local auditing standards applicable in their respective foreign jurisdictions.
It's like speaking different languages.
As the principal auditor, CAM has to take all this disparate, internationally flavored information, inherently trust the professional competence of these other unknown auditors, and somehow synthesize it all to sign his own name on a single, unified, consolidated statement that institutional investors will rely on.
It is a massive leap of faith.
How does the overarching regulatory framework, specifically Standard on Auditing 706 or SA 706, require the principal auditor to communicate this massive systemic delegation of duty to the public markets?
This is a critical point of transparency, and it's something any sophisticated investor must look for when reading a complex annual report. Standard on Auditing 706 explicitly requires the principal auditor to include what is formally known as an other matter paragraph in their final published independent auditor's report.
The other matter paragraph.
The regulatory guidance is meticulous about how this is phrased. The principal auditor must explicitly, quantitatively disclose the magnitude of the portion of the financial statements that they did not personally audit.
They have to put numbers on it.
They cannot use vague language. They cannot just bury a footnote saying, we relied on the work of other independent professionals for certain subsidiaries. The standard demands absolute precision.
So they have to state the exact amounts.
And they must state the exact aggregate financial amounts, or the precise percentages of total assets, revenues, and cash flows audited by others.
How does that actually read in the report?
In the formal draft paragraph provided by the regulatory examples, the principal auditor must explicitly state something akin to: "We did not audit the financial statements or financial information in respect of 8 subsidiaries, whose financial statements reflect total assets of Rs 1,500 crores as at the year end, total revenues of Rs 1,000 crores, and net cash outflows amounting to Rs 10 crores for the year ended on that date, as considered in the consolidated financial statements."
Wow, just putting it all right out there.
By stating these numbers explicitly, the principal auditor is legally drawing a very clear, heavily fortified line in the sand regarding their own professional liability.
They're building a wall.
They go on to state that their final opinion on the consolidated financial statements, insofar as it relates to the amounts and disclosures included in respect of those specific subsidiaries, is based solely on the reports of those other auditors.
They are telling the market, we audited the consolidation process. But the underlying foundational data for these massive divisions relies entirely on the professional integrity of other firms.
Exactly.
That is fascinating. It's a highly formalized, legally bulletproof way of saying, I rigorously checked the architectural math of how all these different pieces were added together, and I ensured the eliminations were correct. But I did not fly to Germany and physically verify the inventory in those warehouses.
That's essentially it.
If those underlying numbers are fraudulent, take that up with the local firm who signed off on them. It maps the boundaries of liability.
It defines exactly what they are taking responsibility for.
But let's go back to those 2 foreign subsidiaries. The sheer complexity of taking financial statements prepared under, say, German local GAAP or US GAAP, and mathematically converting them into the parent company's home country standards, like Indian GAAP or Ind AS. That must be an absolute nightmare of financial translation.
It is a monumental, highly technical task.
Yeah.
And the regulatory standards specify exactly how the chain of responsibility handles this.
How does it work?
The foreign subsidiaries are appropriately audited by local auditors under their local country's statutory standards because they have to pay local taxes and comply with local corporate law.
Right.
Then the heavy lifting falls to the holding company's corporate management. Management, not the auditor, has the primary responsibility to mathematically and conceptually convert those foreign financial statements into the accounting principles generally accepted in the parent's home country.
Wait, so management does the translation?
Yes. This is not just a currency translation. They have to adjust for fundamentally different rules regarding the capitalization of leases, different methods for valuing inventory like FIFO versus LIFO, and different thresholds for recognizing contingent liabilities.
That sounds incredibly complex.
Once management builds this massive translation spreadsheet, the principal auditor steps back in. The principal auditor doesn't fly to the foreign country to re-audit the raw data. Instead, their mandate is to rigorously audit the conversion adjustments made by management.
Ah, they check the translation math.
They verify that the conceptual translation from foreign GAAP to the parent's GAAP was executed accurately and consistently.
This massive reliance on a global web of professionals raises an important question.
It really does.
How does a principal auditor systematically manage the overarching risk associated with relying on the work of so many other people across different cultures and regulatory environments?
This structural risk is governed by another crucial standard, SA 600, which is titled Using the Work of Another Auditor. Under SA 600, the principal auditor has a massive responsibility regarding materiality.
Materiality. Let's define that quickly.
In auditing, materiality is the threshold of error that would change the economic decision of an investor.
Okay.
The regulatory framework clarifies that while a component auditor calculates a specific lower materiality threshold for their individual subsidiary on a standalone basis, the principal auditor must compute a macro-level materiality for the consolidated group as a whole.
A massive group-level figure.
This massive group-level materiality figure is used to assess the appropriateness of all those complex consolidation adjustments we discussed. Furthermore, the principal auditor doesn't just calculate this in a vacuum.
They share it.
They must communicate this group-level materiality down the chain of command to all the component auditors, explicitly instructing them on what specific financial thresholds are important for ensuring the overall true and fair view of the final consolidated statements.
It aligns the entire global audit force to a single standard of precision.
Exactly.
This web of formalized communication is incredible. The principal auditor is essentially acting like the lead conductor of a massive, heavily regulated global orchestra.
I like that analogy.
They are setting the tempo, defining the key, and trusting the musicians to play their parts. They even have to obtain formal written confirmations from all those remote component auditors regarding their independence from the client, their strict adherence to the global code of ethics, and gather specific, structured information required for the complex consolidation entries.
Yes, the conductor has to keep everyone in line.
But keeping with the orchestra analogy, what happens if one of the musicians in this global symphony plays a terrible, wildly out-of-tune note?
Oh, it happens.
Let's look at the scenario of a parent company, TLTD, which is audited by a prestigious firm, RS& Co. One of their massive subsidiaries, BLTD, is audited by a different firm, MN& Co.
Okay, two different firms.
During their local audit, the component auditor, MN& Co., uncovers a massive problem, perhaps a massive unrecorded environmental liability or a fundamental failure in revenue recognition.
A huge red flag.
Because of this, MN& Co. actually qualifies their audit report for BLTD. They issue a modified opinion, essentially waving a massive red flag to the market, saying these specific numbers for this subsidiary are wrong.
Right.
But when it comes time to consolidate, the principal auditor, RS& Co., looks at that red flag, looks at the massive size of the entire global group, and decides to simply ignore the qualification when framing their final consolidated opinion.
Oh, boy.
They try to argue that while the discrepancy is huge for BLTD, it's just a drop in the bucket at the overall macro group level, so they issue a clean, unmodified report for the parent.
Which is a bold move.
Under the standards, is a principal auditor allowed to just unilaterally sweep a component auditor's dire warning under the rug like that?
Absolutely not. The regulatory framework explicitly and forcefully rebukes that approach. This is where the chain of accountability becomes unyielding.
They can't just ignore it.
When a principal auditor is evaluating the finalized reports from the component auditors, and they encounter any observations, structural modifications, or emphasis of matter paragraphs made by a component auditor in accordance with standards like SA 705 or SA 706, the principal auditor cannot simply ignore them or dismiss them as localized issues.
What do they have to do?
The standard mandates that the principal auditor must rigorously evaluate the specific financial impact of that modification in the broader context of the consolidated financial statements.
So they have to run the numbers on the air.
If a component auditor flags a massive discrepancy, like the massive unrecorded liabilities you mentioned, the principal auditor must perform the math to calculate if that specific discrepancy breaches the materiality threshold for the entire group's financial position.
And if it does?
If it crosses that line, the principal auditor is legally compelled to modify their own overarching report on the consolidated financial statements. They must carry that red flag all the way to the top of the corporate structure.
They can't just hide it.
They cannot turn a blind eye just because the problem originated down the chain of command in a subsidiary they didn't personally audit. The accountability and the risk flows inexorably upwards to the signature on the final report.
That is intense.
This entire massive regulatory system reveals a profound truth about global markets. A single, unified global audit report is not the omniscient work of one single firm checking every single invoice.
No, it's a massive collaborative effort.
It is a highly structured, heavily regulated patchwork quilt of professional trust, standardized global communication, rigorous and complex conversion adjustments, and meticulous legal documentation spanning dozens of different independent accounting firms worldwide, all bound together by the uncompromising rules of standards like IND S 110 and SA 600.
It is truly staggering when you step back and look at the sheer scale, the architectural complexity, and the profound legal responsibility of it all.
It's a massive machine.
We have covered an incredible amount of dense, highly technical ground today, translating a rigid regulatory framework into the realities of global finance.
We really went deep today.
Let's briefly recap the journey we just took through this hidden world. We started by dismantling the illusion of temporary control, discovering how the uncompromising day-to-day precision of INT S 110 aggressively shuts down any attempt by corporate management to use stock-in-trade loopholes or short-term holding arguments to hide highly leveraged, poorly performing acquisitions off their consolidated balance sheets.
Right, closing those loopholes.
We then explored the fascinating, counterintuitive reality of operational control, Learning how a mathematically insignificant 10% voting share can legally equate to absolute, unquestioned corporate dominance if a parent company holds the strategic reins of the board of directors through complex technology licenses or restrictive supply chain agreements.
Turning the modern auditor into a corporate forensic detective.
We found the lone wolves of the corporate ecosystem, the investment entities, and understood the fundamental economic logic of why forcing a venture capital fund to operationally consolidate its wildly disparate startup holdings would create meaningless financial noise, and how the rules provide a highly structured fair value exemption to provide clarity to investors.
Providing signal instead of noise.
We looked over the shoulder of the auditor, diving deep into their investigative toolkit, realizing the absolute necessity of bypassing management's narrative to check the raw data in statutory registers like Section 186 and 190, and we examined the critical, legally binding psychological leverage of written representations to prevent executives from conveniently forgetting related parties or artificially inflating revenue through intragroup transactions.
Holding them accountable.
And finally, we navigated the staggering multinational complexity of the principal auditor. Understanding how massive global audits are painstakingly stitched together through the mandates of SA 600 and SA 706, relying on a delicate, heavily documented web of professional trust, strict group-wide materiality thresholds, and highly transparent other matter paragraphs that define the very boundaries of legal liability.
It is a lot to process.
The next time you are analyzing an annual report or you see a multinational company's consolidated earnings flash across the financial news, you will know exactly how much rigorous, often combative verification, global cross-checking, and strict adherence to these heavy accounting standards went into producing that single, seemingly simple sheet of numbers.
You'll see the whole picture.
You are no longer just looking at the polished surface of the corporate narrative. You know exactly how the invisible regulatory architecture underneath actually holds the entire building up.
That is the true power of understanding the underlying mechanics of our financial systems. It changes how you consume information.
It really does.
And to leave you, the listener, with a final, broader thought to mull over, I want to build on that evolving concept of control that we spend so much time dissecting today.
Where do we go from here?
We saw how historical accounting standards had to undergo a massive evolutionary leap, moving from a simple, easily manipulated mathematical assessment of 51% share percentages to a much more complex, nuanced assessment of real-world operational influence, evaluating things like board control, veto rights, and technological dependency under IND AS 110.
The evolution of control.
This was a necessary, painful leap to keep up with the realities of modern, highly engineered business structures. But if we look forward, how will these rigid regulatory standards adapt to the rapidly approaching future of corporate governance?
Oh, that is a big question.
Imagine a financial landscape, which is already taking shape, dominated by decentralized autonomous organizations, or DAOs. Imagine massive, capital-rich corporate subsidiaries or investment vehicles that are entirely managed by highly advanced AI algorithms running on decentralized blockchain networks, executing trades and allocating capital with absolutely no human board of directors at all.
When the machines take over the boardroom.
When the very concept of control is no longer dictated by human beings sitting in a boardroom, but is instead hard-coded into immutable blockchain smart contracts, or dynamically distributed among thousands of anonymous transient token holders globally. How will the statutory auditors of tomorrow legally define who is truly the parent company?
That is going to be wild.
If an artificial intelligence dynamically alters its own operational parameters and supply chain dependencies based on machine learning, who actually wields the operational control that standards like IND AS 110 try so desperately to capture? The fundamental nature of corporate structure is decentralizing and automating at a blistering pace, and the auditing standards that protect the integrity of our global financial system will have to undergo another even more massive evolutionary leap to figure out how to audit a corporate parent that might not even be human.